Appreciate it. Here's our agenda for today. We're going to leave you with some real clear advice about the importance of an emergency fund. Like, it's one of the first things you should do when you get going. When you get out of high school at university, it's not a bad idea to even get one going now. The importance of emergency funds. We're going to look at finance and well-being and how much damage poor financial literacy can do to your well-being. We're going to talk about students who are feeling some of these stresses. And then we're going to talk about millennials who are really discontent because they've already piled on huge amounts of debt, and that's unfortunately causing them some discomfort. We're going to look at housing. Housing is taking off. It's spring. The market is hot. And so we'll give you some advice on housing because down the road probably you'd like to live in a house as opposed to renting for too long, although there's nothing wrong with renting. We'll talk about that too. I had a request from a member about talking about Tangerine, and I want to get going now. How do I actually do this? So I'm going to take you to the Tangerine site and get going. It kind of dovetails with this idea of having an emergency fund. And then we'll talk a little bit about Apple. Apple had quarterly results that beat the street in some ways, and so we would expect their shares to do something. Let's see if they actually did that. Okay, so off we go. The importance of emergency fund and why you have them. First of all, you have one because you're going to have emergencies. If someone came up to you and said, hey, guess what? On the 15th of May, you're going to have a big bill come, and you're not going to expect it, blah, blah, blah. Well, guess what? You'd plan for it. But emergencies happen. Storms are coming. And what you want to have in place is a little fund so that if a storm hits, you're good. The standard thinking here is 3 months' salary. Have 3 months' salary sitting in cash. So, do most people do this? No. They look and they have a line of credit and they say, well, if I have an emergency, I'll just tap into my line of credit. The problem is, the emergency might be a job loss or a job reduction, perhaps a spouse job loss. So now look at the mess you're in. So instead of accessing money you have in your emergency fund, now you're going to use a credit card. That's what a line of credit is, right? A big old credit card with a lower interest rate. You're going to use a credit card to fund you for a period when you don't have any income coming in. So I cannot stress with you. It would be like job one. Don't do anything else unless you build up an emergency fund. All right, so if we're going to do that, we'd like to make a little bit of interest. And so, Carrick, our friend Carrick, is now identifying one of the top spots, a new account that's been created, to get a little interest. It's Manulife. Now, we wouldn't expect Manulife to do something creative on the on this side because they're kind of an old, 131-year history. You know, we'd expect maybe one of the smaller fintechs to do it, but here's Manulife. Well, good for them. What are they doing? They've created something called an Advantage account. Fills a gap for people who bank online, want to park their savings in an account. That's an emergency fund. Park their savings in an account that provides both a decent rate of interest and some utility for paying bills, etc., etc. Interest rate on the thing is 1 1/4. One of those tiresome temporary promo deals will pay you 2.5 until the end of the summer. Keep a minimum $1,000 in there, and you can do unlimited banking for free among the included transactions: debits, e-transfers, withdrawals. The Advantage account is technically savvy too, paperless account opening, nice and slick, mobile apps on your phone. So a key piece of financial planning is having an emergency fund. When I was younger with kids, literally we were struggling to make ends meet. It's tough. And so, you know, we'd get a car bill, $2,000 car bill, right? And I'd be like, oh my gosh. Well, you know, if you have an emergency fund and you have 6,000 or 7,000 sitting there, yeah, it still hurts to get a $2,000 car bill, but you can still function, right? And then once you spend the $2,000, you build the fund back up. So really the importance of emergency funds. Obviously, Tangerine is a spot we can go to there too. The members' question that I received was just more about tax-free savings accounts. I want to cover that separately. All right, financial well-being. Some stats that I saw in the Globe. Check this out. Canadians roll into the workforce with an average nearly $27,000 in student debt. Now, don't get me wrong. Student debt, borrowing money to finance your education, is a fantastic idea. You're spending money on yourself. But be careful of where you go. If you head down to Queen's or Western or U of T and you're going to take a degree program that you can get in our backyard, I would really question that. Laurier, U of W, Guelph, you could easily drive to Guelph, get a little car and commute. You can even commute to Western. Conestoga, they're fantastic schools. Now, if you're going to UBC to do a special program, blah, 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 or you're going to Ottawa to do something in poli-sci, fine. But if you're going to go and do a business degree and you're leaving KW and you're going to take all that debt on, you're not going to get scholarship money, I really start to question why you're doing that. Do you know what it feels like to graduate from university with $27,000? That hurts. Puts you behind the 8 ball right away. Makes it really tough for you to get a car if you want to get a car. All of a sudden, you got to pay that back. Right? So your salary is kind of going to be impacted. And so I would caution you about that. Unfortunately, that is the reality. Most kids hurting. This is a perfect example of the lack of financial literacy. This would be like example 1. Over half of Canadians say they don't have any idea how much they need to save for retirement. Well, the number's about 60% of your last year's work. That's the number that people banty around. So if you're going to retire, you're making, I'll just keep the math easy, you're making $100,000. That's about $60,000 that last year is 60% of that. If you can pull that out of your savings, and then you start doing the math, saying, okay, I'm going to live to be 90, I retire at 60, that's 30 years. Let's just do that. Grab a calculator. So let's say your final salary, your last year of work is $100,000. 60% of that is $60,000. So type in $60,000 on your phone, your calculator. You're going to retire at 60. You're going to live to 90. 30 years of that. Well, that's $1.8 million for you. And maybe your spouse would like to have some money too. You're doubling it, 3.6. So now we're not even talking about inflating that. $4 million. A lot of money. Now, obviously, you're going to have years and years of earning to accumulate that. You're talking about working from 25 to 60. But you've got to be disciplined and save. What that tells you is that half of Canadians have no idea how to retire. They have no idea what they're doing. Total lack of financial literacy. Scary. Kids are freaked out. I mean freaked out. Today's post-secondary students experience a multitude of mental health issues. How appropriate I read this to you during Mental Health Awareness Week. During their university years. Look at this number. More than 46% of respondents indicated they felt so depressed it was difficult to function. 1 out of 2 kids is under so much pressure at university they can't even function. They're overwhelmed. You don't think debt's in there, do you? You bet you it is. 61% felt things were hopeless. Those are kids at university. Imagine the cohorts that, are on different pathways and aren't sure what it looks like. It's 1 of every 2 kids wandering around Laurier, UW, Conestoga, feeling depressed. So, your financial literacy matters. It's a huge piece of your mental well-being, without a doubt. Let's have a look at millennials and see how they're doing. Not great. Lingering economic woes sow seeds of discontent. In other words, they're not happy. Survey highlights sentiment that the country's current economic system benefits older generations over younger ones. Carrick again. Young adults living with their parents or renting because buying a house is an unaffordable are starting to get restless. New survey of 18 to 37-year-olds, 40% said their generation is mostly or much worse off compared with their parents. 54% said the economic system in Canada benefits older generations. Asked whether capitalism is the best model, if we'd be better off with a more socialist program, half said socialism. Socialism means base salary for everybody. Base salary. We take care of everybody at a base level. By the way, as a little sidebar, I was explaining in my grade 12 accounting class today that we've got now built-in regional unemployment in sectors in the country. BC's unemployment rate's about 6%. Some of the Atlantic provinces are running 15% unemployment. And what's happening, of course, is the unemployment benefits that are going out east are so high that there's no incentive for those folks to move where the jobs are. Provinces, Nova Scotia.
Call 5601, Ms. Hilborn, 5601.
And the government has propped that up so much that I have no incentive to go to BC and get a job. And the reason that's happening, of course, is so the politicians can get elected in Atlantic Canada. Think about that. They're making it so comfortable to be unemployed and be on unemployment that you're not even going to move to where the jobs are. So this is horrible for the country. But again, politicians' job number one, get reelected. And so we need to be aware of that. So this is this idea of, man, I just like to, someone take care of me. Please take care of me. 2/3 of the participants say they were very or mostly optimistic about the future of Canada. Clearly, we are still away from the point of millennials giving up. That's you, Vic. Owning a home, retiring in comfort, yet the level of discomfort among young workers is striking. Millennials were raised to think there would be lots of opportunities and jobs. Very high expectations were set. More and more millennials are entering the workplace. Reality hits. 4 in 10 participants were getting or had received help from parents to cover the rent. 55% had parental help at some point to cover regular expenses like groceries. 30% they didn't have any savings. 22% said they had less than $5,000. I would say this is a function of this ridiculous system we have where no one fails anything. Nobody fails any courses here. Right? Credit rescue, credit recovery. Go up to your teacher in late May and say, hey, what do I have to do to pass? Farcical. And then they get out there, they expect it to continue. Yeah, question? Did you have a question?
Well, I was just going to ask, the average net worth of an adult Canadian is $200,000. That's subtracting to that, including everything that they have.
So, 200,000, let's just talk a moment. How long is that going to get you in retirement? 200,000, like, you better die quick. That's the problem. You're going to outlive your money. 200,000, like, one of the things I shared with you really, really early is you need to be a millionaire. Like, a millionaire is like absolute bottom. And so if I go in, you guys understand this, but if I go into a grade 10 workplace math class and say, all of you need to be millionaires, they'd be like, it's because no one teaches you this. All right, housing. You're not going to like this. 70! Hey, I'm going to save till I'm 70 till I can afford to buy a house. This is Carrick again. What's he saying? You might have to work until you're 70 to afford a house. Prices, mortgages, everything's higher. First-time buyers looking down the markets are left at a crossroads. Common theme in all that's going on in the housing market today, none of it good for you guys. Prices are rising sharply. Montreal, Ottawa, astronomical expensive. Vancouver, Victoria. Prices are flatter, weaker in other cities. There's little to no improvement in affordability thanks to mortgage rate increases like we're seeing happening. On top of all this, tough stress test buyers must take. Full-on housing market crash would save the day for first-time buyers who can't afford today's prices. But that appears likely, not likely, that appears unlikely without the economy stalling, interest rates surging. One of the good things about our slow-growing economy is that neither of these extremes seems likely right now. This leaves wanna-be buyers at a crossroads. Either make your peace with renting or keep saving in the hopes of getting in the market at a later date. One of the benefits of longer lifespans is that you can push ahead milestones such as home buying, retirement. Here's my advice to you. There's nothing wrong with renting. What you're going to have to do, though, is whatever you pay in rent, you need to take an extra $1,000 a month and stash it away. Because you know what happens with rent? It's gone. At the end of a year, every penny you pay in rent disappears. You paid it to rent the space. So you're still going to have to start to accumulate a down payment. I would be cautious, though, of jumping into the housing market as soon as you graduate university or college. Simply because there's a good chance that you'll be transferred. I'll give you an example. One of Brendan, my younger guy's classmates, took a job at Deloitte for the summer. So really excited, interviewed, got the Deloitte spot. First day of training, they said, we're going to move you down to Windsor for 6 weeks to do an audit down there, an interim audit. Well, that sounds great, except the problem is he's already got a spot rented here in town. Think if he had moved, and they had moved him to Windsor permanently. Hey, we're going to transfer you to Windsor. Now you'd be like, oh my gosh, I got to sell the house and So I would advise you to consider renting as a real long-term option until you believe you're going to stay put for a decade. In other words, early on as you take job. If you're comfortable enough in a certain role to believe you can stay there for a decade, then go ahead and enter the housing market. If not, continue to rent. Because as soon as they lock you, if they offer you a transfer to Calgary, now you got to sell your home and the housing market might be cool. And if you rent, just walk away. Okay, so that would be a strategy that I would encourage you to embrace. There are nice apartments in town, really nice apartments in town. There's nice condos in town. You could rent a condo. Entry level would be a townhouse or a condo, right? And that's an option too. Don't try to get into your mom and dad's home now. The reality is you're going to step there, right? It might be renting first, then a townhouse, then kind of move into your home when you have your kids and blah, 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 blah down the road, if you so choose that path. All right? So what they're saying is it's white hot right now. It's going to continue to grow, but your salaries will grow too. Think about it. If the economy's growing, housing's growing, salaries will grow. So you're going to get yearly salaries, especially during the early stages. So don't be afraid of this. All I'm saying is if you're going to pull the trigger on housing, have some certainty you're going to be in the same spots for a given number of years, or else you have some risk. Because if it cools, and you got to sell when it cools, you're going to learn, you're going to lose a bunch of capital. We don't want that to happen. All right? Housing. I had a question about Tangerine. So we're starting to get some questions about, okay, like I want to get going on this. How do I do this? So let's just take a moment and have a peek at Tangerine. So here's Tangerine. This is their home page. So there's a page on savings. So we know about their savings account. Again, a great spot to park an emergency fund, right? Pay yourself every 2 weeks. Take 10% of your salary and slide it over. They also have, though, an investing tab. And under investing, there's there are tax advantaged options here. Tax-free savings account, RSPs. A RIF is a retirement income fund. You don't worry about that through 71. So tax-free savings account. As I've mentioned to you, you don't buy a tax-free savings account. A tax-free savings account is an umbrella. We use a tax-free savings account because it protects us from tax. We purchase something inside the tax-free savings account, let it grow tax-free. Don't walk into the bank and ask for a tax-free savings account. So at Tangerine, you have choices. You can put several things inside a tax-free savings account. One of it could be just a simple GIC. So we know the story of the GICs. They pay low interest rates. 3% is nice. That's a teaser rate, but you get 3%. You buy a GIC, put it in a tax-free savings account, let it grow 3% tax-free. You get to keep the 3%. For me, when I see something 3%, I'm going to lose half of it because of income tax laws, right? Unless it's in a tax-free savings account, in which case it's protected. So that's an option. However, the member was asking not so much about a GIC option as an investment fund option. So we know what this is. So these are the index funds. So we like Tangerine because their investment options are the index funds. We know this story. Index funds are fantastic because on average 80% of them beat active managed funds. So you could say, well, you know, I had a mutual fund advisor come to my house and they said they've got a real hot fund. And I'm like, fantastic. Tell me if that fund will be hot next year. Because we know there's an 80% chance that just the boring, passive, couch potato portfolio will beat index funds. Historically, that's the average. So we want to avoid actively managed funds, which are charging you 2 to 3% for underperformance. And we want to embrace the couch potato index strategy. Costs matter. We get global diversification, and you invest automatically. And so options underneath that offering are across the continuum in terms of risk. So we go from very aggressive here, all equity, to much more balanced, more income-friendly funds. If I look at the equity growth fund, you can see it's all equity. A third Canadian stocks, a third US stocks, and a third international stocks. Now, you know what I'm going to say next, and that is that's way too much Canada. Way too much Canada. However, you know, if you're just starting and you got $5,500, you just turned 18, it's your first tax-free savings account, you're going to commit to saving this long-term for long-term goals, that's fine to start. Don't be worried at all. All right, but that's the way you do it. So hopefully that handled the member's question. Great. Of companies that buy back shares. So Apple just came out with their quarterly results, smoked estimates, and are going to boost capital returns. Despite shrinking global smartphone demand, iPhone maker posts strong March quarter. Apple on Tuesday beat revenue and profit expectations. So we know what that means, right? Beating means it beat Wall Street, Bay Street, professional money managers' expectations of how they do. Beat the street. That's good news. Once you beat the street, shares will rally. In its March quarter, sold 52 million iPhones, barely below the Wall Street targets, showing some resilience, global demand for as smartphone wanes. Company also predicted revenue range of US 51 billion, US 53 billion for the June quarter, midpoint ahead of the US 51 billion Street expected. Apple, here we go, boosted its capital return program by US 100 billion. So what does that mean? That means they're going to buy back their own shares. That means they're sitting on so much cash they don't know what to do with it, but they believe their shares are cheap. And so they're going to use their own money to buy back shares. What that does is shrink the float. My easiest example for you is this. You have a big barbecue in the summer over at Nana's, and a whole bunch of your stupid cousins are going to come, and you look at the dessert counter, and you're like, look at all this strawberry pie here, we've got some ice cream, and then you find out one of the busloads of your stupid cousins aren't coming, you're going to get more ice cream. Think of the ice cream as profits. Once a company buys back shares, it eliminates shareholders, the earnings per share goes up because there's less people at the party. You get more sweets. How much? Let's have a look. 100 billion. Repurchases from the increase set to begin in June quarter. Said it bought back 23 billion of stock in the March quarter, a sign that it is bringing back most of its hundreds of billions of dollars in cash reserves to the U.S. Share repurchases in the March quarter drove Apple's cash net of debt down slightly to US 145 billion. So they only have $145 billion left in the bank. What does that do to share price? Well, if you wanted to take a guess, you'd say it'd be good for share price. If you guessed that way, you'd be right. If I have a look at the technical analysis for Apple, here I've got it queued up for you. I look at the chart. If I look at the 5-year, and I add a trading channel here, I ignore the baby blue line. It's for some. It's a tech ETF, and for some reason I can't get out of there. You're looking at the dark blue line. So what do my eyes see? Well, my eyes see that there have been moments in recent times when this has dipped down into the trading channel. We are down in the trading channel. We traditionally have been above the trading channel. What do my eyes see? Well, my eyes see that when we're above the trading channel, we peel down, and we're below the trading channel, we come back up. We kind of try to stay in this trading channel. So this is a day trader's dream, because what they can do is when it gets up here, they can sell it. And they can wait for the pullback, and now it's below, and they buy it. And they wait for... It's out of the channel. When it's out of the channel, it presents opportunities for you. And recently here, you can see that it's peeled back into the... It's been above, it's peeled back in, which means it's created a little buying opportunity for us. If I pull back and look at the shorter term line year to date, you can see that there's the announcement of the quarterly results, and it's rallied very nicely at that point. So as you would expect, shares will move on news in a good way or a bad way as the market digests that. Because Apple was able to beat the estimate, it rallied. I'm an Apple shareholder. Yum, yum. That's it for this week. See you next time.